Before we dive in, a quick but critical disclaimer. I am not a licensed insurance agent or financial advisor. This presentation is for educational and entertainment purposes only, and should not be taken as financial advice. The world of insurance is complex and varies by state and individual circumstance. Always consult with a qualified and licensed professional before making any decisions about your policy. Your financial well-being is your responsibility. Let me tell you about a guy named Mark. Mark was the perfect driver. 15 years, not so much as a parking ticket. He paid his auto insurance bill, $162, on the first of every month like clockwork. He thought he was covered. He thought he was protected. Then came a rainy Thursday afternoon on the interstate. Traffic slowed suddenly, the car in front of him slammed on its brakes, and despite his best efforts, Mark's sedan slid on the wet pavement and tapped the bumper of the brand new Mercedes in front of him. A tap. Barely looked like a scratch. The other driver, a lawyer, complained of neck pain. Fast forward 6 months. Mark was facing a lawsuit for $200,000 for long-term soft tissue damage, and another $22,000 to replace the Mercedes' damaged high-tech bumper and sensor array. And that's when Mark discovered the devastating truth hidden in the fine print of his Good Deal insurance policy. He had only opted for the state minimum liability coverage. His policy paid out the maximum of $25,000 for the injury and $10,000 for the car. And the other $217,000? That was now Mark's problem. A lien was placed on his house. His wages were garnished. His savings were wiped out. 15 years of perfect driving, undone in 15 seconds. All because he didn't understand what he was actually paying for. This story, or a version of it, happens thousands of times a day across America. And it happens because the auto insurance industry is built on a foundation of confusion. They use confusing terms, complex numbers, and fine print designed to make you feel like you're covered when you might be dangerously exposed. My goal with this video is to shatter that confusion. We are going to break down the 5 most critical things every single driver in the United States needs to know about their auto insurance. This isn't about finding the absolute cheapest rate. It's about finding the smartest protection. By the end of this, you will understand what you're paying for, you'll know the traps to avoid, and you'll be able to build a policy that acts as a financial fortress around your life, not a piece of paper that fails you when you need it most. So let's get right into it with the absolute bedrock of every single auto policy in the country. The first key thing you must understand is this: liability coverage is not for you. It does absolutely nothing to protect you, your passengers, or your car. Liability coverage is for everyone else. It is your financial shield to protect you from the financial devastation of being sued when you are at fault in an accident. When you cause an accident, you are legally responsible, or liable, for the damage you cause. This isn't just a moral obligation. It's a legal one that can destroy your financial future if you're not properly protected. Liability coverage is broken down into 2 critical parts. The first is bodily injury liability, or BI. Think of this as your personal financial bodyguard. If you cause an accident that injures or, in the worst-case scenario, kills someone else, this is the part of your policy that pays for their medical bills, their lost wages from being unable to work, their pain and suffering, and crucially, your legal defense fees if they decide to sue you. Without this, you're paying for all of that out of your own pocket. A single multi-day hospital stay can exceed $100,000. A lawsuit can run into the millions. Bodily injury liability is what stands between you and that catastrophe. The second part is property damage liability, or PD. This one is more straightforward. It pays for the damage you cause to other people's property. Most of the time, this means the other person's car. But it also covers anything else you might hit: a mailbox, a storefront, a guardrail, a fire hydrant, a custom-built brick fence. You name it, if you hit it and you're at fault, your property damage liability is what pays to repair or replace it. Now, this is where most people get lost. On your insurance declaration page, you'll see a series of 3 numbers separated by slashes, something like 25/50/25 or 50/100/50. This isn't just random insurance code. It is the absolute limit of your financial protection, and you need to know what it means. Let's break it down using a common example. 50/100/50. The first number, 50, stands for $50,000. This is the maximum amount your insurance company will pay for any single person's bodily injuries in an accident you cause. If one person's medical bills and lost wages total $70,000, your policy pays the first $50,000, and you are personally on the hook for the remaining $20,000. The second number, 100, stands for $100,000. This is the maximum total amount your insurance will pay for all bodily injuries combined in a single accident, no matter how many people are hurt. Let's say you hit a car with 3 people in it. Person A has $40,000 in medical bills, Person B has $40,000, and Person C has $40,000. That's a total of $120,000. Even though no single person went over the $50,000 individual limit, the total exceeds the $100,000 accident limit. Your policy pays $100,000, and you are getting a bill for the last $20,000. The third number, 50, stands for $50,000. This is the maximum your policy will pay for all property damage in one accident. This is pretty simple if you hit one Toyota Corolla. But what if you cause a chain reaction on the freeway involving 3 or 4 cars? What if you slide on ice and hit a brand new BMW X5, which costs $80,000? Your policy pays the first $50,000 for the bimmer, and the other $30,000 is coming directly out of your bank account. Now we arrive at the single biggest and most dangerous trap in the entire auto insurance industry: the state minimum requirement. Every state, except for a couple of outliers, mandates that you carry a minimum amount of liability insurance to legally drive. In some states, these minimums are terrifyingly low. We're talking limits like 25/50/10, which is $25,000 for a single injury, $50,000 total for all injuries, and a measly $10,000 for property damage. Following this law gives you a false sense of security. Being legal is not the same as being protected. Let's be brutally honest. $10,000 for property damage in 2024 is a joke. The average price of a new car is approaching $50,000. Even a minor fender bender with a luxury vehicle equipped with complex sensors and cameras in its bumper can easily exceed $10,000 in repairs. If you have that 25/50/10 policy and you rear-end a new Ford F-150, you could exhaust your entire property damage limit before they even finish the estimate. The rest is on you. The same goes for the injury portion. Think about the costs of healthcare. An ambulance ride, an emergency room visit, a few x-rays, that can blow past a $25,000 limit in a single afternoon. Choosing the state minimum is like trying to protect your home from a hurricane with a beach umbrella. It's technically there, but it's going to fail spectacularly when you actually need it. The few dollars you save each month on that cheaper premium are pennies compared to the life-altering debt you could face after one single mistake on the road. So how much should you have? The standard responsible recommendation from most financial experts is to carry at a bare minimum 100/300/100. That's $100,000 for a single injury, $300,000 total for injuries, and $100,000 for property damage. However, the best rule of thumb is this: you should have enough liability coverage to protect your net worth. Add up the value of your assets, your home equity, your savings, your investments, your future earning potential. If that number is, say, $100,000, you need a policy that can protect that amount. Because if you cause an accident and the damages exceed your policy limits, the other party's lawyers will come after your assets to collect the difference. They can and will go after your house, your savings, and your future. Getting your liability limits right is the number one non-negotiable step to ensuring a car accident is just a bad day, not a financial death sentence. So now that you've built a fortress around your financial life, let's talk about the very thing you're trying to insure in the first place: your car. You could have $1 million in liability coverage, but if you back into a light pole in a parking lot, that liability coverage will do exactly zero to fix your crumpled bumper. It's not designed for that. That's where the second key thing you need to understand comes in: the crucial difference between collision and comprehensive coverage. Most people lump these together. They think, oh, I have full coverage. But full coverage isn't an actual insurance product. It's just a phrase people use, and it can be dangerously misleading. What it usually means is that you have liability plus collision plus comprehensive. And you need to understand these two are completely different shields that protect you from different dragons. Let's start with a story. Meet David. David is a smart guy. He listened to the advice about liability, got high limits, and felt secure. He lives in a rural part of Pennsylvania. One evening, he's driving home down a familiar wooded road. The sun has just set. It's that dusky gray time of day. Out of absolutely nowhere, a massive buck leaps directly into his path. There's no time to react. The impact is jarring. Airbags deploy, the car spins to a stop. David is shaken, but thankfully he's okay. His car, however, is not. The entire front end is destroyed. Hood crumpled, radiator smashed, Headlights gone. It's a mess. He calls his insurance company confident. I have great insurance, he thinks. The agent asks, okay David, I see you have excellent liability coverage. Do you have comprehensive coverage? David freezes. He remembers trying to save a few bucks a month. He'd thought, I'm a safe driver. I don't get into accidents. So he had rejected it. The agent delivered the news. The $7,000 in repairs to his car would not be covered. Hitting an animal is not considered a collision, in the traditional sense. It falls under comprehensive. David's attempt to save $30 a month ended up costing him $7,000 out of pocket. David's mistake is incredibly common. He confused the purpose of the two coverages. Let's break it down so you never make that same mistake. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. This could be another car, a tree, a guardrail, a fire hydrant, or that pesky light pole in the parking lot. It also covers rollovers. The single most important thing to remember about collision is that it pays out regardless of who is at fault. If someone runs a red light and T-bones you, their liability insurance should pay for your car. But what if they're uninsured? Or what if you're the one who makes a mistake? What if you misjudge a turn on an icy road and slide into a ditch? That's on you. And that's when your own collision coverage becomes your financial superhero. Now for comprehensive. This is the one that confuses people, but it's actually pretty simple. Think of comprehensive coverage as the act of God, or weird stuff policy. It covers damage to your car from almost everything except a collision. This includes theft. It includes vandalism. Someone keys your car or smashes a window. It covers fire, floods, hail, falling objects like a tree branch, and as David learned the hard way, hitting an animal. It's the coverage that protects your car from the chaos of the world when it's not even moving. A hailstorm dents your roof while it's parked in your driveway? That's comprehensive. Your catalytic converter gets stolen overnight? Comprehensive. Both of these coverages come with a deductible. A deductible is the amount of money you have to pay out of pocket before the insurance company starts paying. Think of it as your copay for a car repair. Deductibles typically range from $250 to $1,000, or even more. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium. It's a trade-off. You're betting against yourself. If you choose a $1,000 deductible, you're betting you won't get into a small fender bender that costs $900 to fix. You're saving money every month, but you need to be sure you have that $1,000 ready to go at a moment's notice if something happens. A good rule of thumb is to pick the highest deductible you can comfortably afford to pay tomorrow without financial strain. This brings up a huge question. Do you even need these coverages? The law in most states doesn't require you to have collision or comprehensive. But if you have a loan or a lease on your car, your lender will absolutely require you to have both. They have a financial interest in that car, and they want to make sure their investment is protected. But what if you own your car outright? The decision comes down to a simple question. Could you afford to replace your car tomorrow with cash if it were destroyed? If the answer is no, you need collision and comprehensive. If your car is an older, paid-off vehicle worth maybe $2,000, and you have a $1,000 deductible, you're paying a premium every month for a maximum potential payout of only $1,000. In that case, it might make financial sense to drop these coverages and self-insure. Basically, save that money yourself for a future repair or replacement. But this is where we have to talk about one of the most misunderstood concepts in all of auto insurance: actual cash value, or ACV. When an insurance company pays out a claim under collision or comprehensive, they don't pay you what you paid for the car. They don't pay you what it would cost to buy a brand new one. They pay you the actual cash value. ACV is the value of your car the second before the accident happened. It's the replacement cost minus depreciation. They look at the year, make, model, mileage, condition, and recent sales of similar cars in your area to determine this number. And it is almost always less than you think it is. This creates a nightmare scenario for millions of Americans. Imagine you buy a brand new car for $35,000. You drive it off the lot and its value immediately drops. A year later, you get into a serious accident, and the car is declared a total loss. This means the cost to repair the car is more than the car is worth. The insurance company calculates the ACV of your one-year-old car is now $26,000. But here's the problem. You still owe $30,000 on your car loan. So the insurance company cuts you a check for $26,000. You pay that to the bank, but you are still on the hook for the remaining $4,000. You are now $4,000 in debt, with no car to show for it. You are literally paying for a ghost. This is called being upside down or underwater on your loan. And it's a terrifyingly common financial trap. But there is a way to protect yourself. It's a special type of coverage, often sold as an add-on, called gap insurance. Gap insurance does exactly what its name implies. It covers the gap between the ACV of your vehicle and the amount you still owe on your loan or lease. In our example, that $4,000 difference would have been completely paid for by gap insurance. It is an absolute unequivocal must-have if you are financing or leasing a new car, especially if you put little or no money down. It's usually inexpensive, and it can save you from a devastating financial blow. Ask your insurance agent about it. Don't assume you have it. So let's recap. You need liability to protect your assets from others, but you need collision and comprehensive to protect your own car. Collision is for accidents. Comprehensive is for everything else. And if you have a loan or a lease, you need gap insurance to protect you from the depreciation trap. You've protected your assets, you've protected your car. But what about the single most important thing in that vehicle? You. What happens when you're the one who gets hurt? Who pays for the ambulance, the emergency room, the weeks of physical therapy? That's where things get even more personal and even more complicated. Let's talk about the flash of red and blue lights in your rearview mirror. Not the police, but the ambulance. The paramedics are asking you questions you can't quite answer. Your head is throbbing. Your arm feels like it's on fire. You're strapped to a backboard, and the world is a blurry, siren-filled nightmare. In that moment, the last thing on your mind is a policy number or a deductible. But the decisions you made months or even years ago are about to become the most important financial choices of your life. This is where we peel back the third critical layer of auto insurance: protecting yourself. We're moving beyond the metal and into the medical. There are three main players in this arena, three coverages that are designed to be your personal safety net: personal injury protection, medical payments coverage, and the unsung hero, uninsured motorist bodily injury coverage. They sound similar and frankly confusing, but understanding the difference between them is like knowing the difference between a first aid kit and a trauma surgeon. Let's start with personal injury protection, or PIP. You'll also hear it called no-fault coverage. And that name is the key. In states that require PIP, it doesn't matter who caused the accident. If you are injured in a car crash, your own insurance company is the first to step up and pay for your medical bills, up to your policy limit. Think about that. You don't have to wait for the other driver's insurance to investigate. You don't have to argue with an adjuster about who ran the red light while you're trying to schedule an MRI. Your coverage kicks in immediately. Let's imagine a guy named Mark. He lives in a no-fault state like Florida or Michigan. He gets T-boned by someone who was texting and driving. Mark's leg is broken in 3 places: the ambulance, the emergency room, the surgery to insert a metal rod, the hospital stay. The bills start piling up. They're coming in faster than junk mail. Because Mark has PIP coverage, he submits those bills directly to his own insurance company. They start paying right away. But here's where PIP becomes so much more than just health insurance for your car. It doesn't just cover medical bills. Mark is a contractor. If he can't walk, he can't work. He's out of a job for 3 months. PIP can cover a significant portion of his lost wages. Suddenly, he can still pay his mortgage. He can still buy groceries. The accident was a physical and emotional disaster, but thanks to PIP, it's not an immediate financial apocalypse. Gets even better. Mark's wife has to take time off work to drive him to his endless physical therapy appointments. PIP can sometimes reimburse for things like that. If Mark needed someone to come in and help with things he can no longer do, like childcare or even just mowing the lawn, PIP can cover those essential services. It's designed to help you maintain your life, not just patch up your body. But what if you don't live in a no-fault state? What if you live in a state like California or Ohio, a traditional at-fault state? In that case, you won't have PIP. You'll have its cousin, medical payments coverage or MedPay. MedPay is simpler. It's a straightforward pot of money set aside specifically for medical expenses resulting from a car accident. Like PIP, it pays out regardless of who is at fault. If you have a $10,000 MedPay limit, you can use it to pay for your ambulance ride, your x-rays, your chiropractor visits, right up to that $10,000 limit. It's fast, it's easy, and it's direct. Unlike PIP, however, MedPay typically does not cover lost wages or those other essential services. It is purely for medical bills. And this is where I hear the biggest objection. Why would I need MedPay if I already have good health insurance? It's a fair question, but it's based on a dangerous misunderstanding of how this all works. First, your health insurance has deductibles and copays. A major accident can easily max out your annual deductible in a single day. Your MedPay coverage can be used to pay for that deductible and all your copays, meaning you might pay literally $0 out of your own pocket for your medical care. Second, your health insurance might have network restrictions. The best trauma surgeon in your area might be out of network. Your health plan might cover only a small fraction of their bill, leaving you with a staggering debt. MedPay doesn't care about networks. Pays the bill, period. But here is the single most important reason, the one that almost nobody knows. In the event of a car accident, your auto insurance is generally considered the primary payer. Your health insurance is secondary. This means your health insurance company will often wait to see what your auto insurance pays first before they will cover a single penny. They can, and often will, deny your claims and tell you to submit them to your MedPay or PIP first. They may even put a lien on any settlement you get from the at-fault driver to get their money back. Having MedPay or PIP smooths this entire process out, providing immediate cash to doctors and hospitals so you get the care you need, when you need it, without a fight. So you have your own injuries covered, either by PIP or MedPay. You're on the mend. But then you get the phone call from your adjuster. It's the news you were dreading. The driver who hit you, they have no insurance. Or, almost as bad, they have the absolute bare minimum state-required coverage, which in some states is as low as $15,000. Your surgery alone costs $50,000. The person who caused all this pain, all this disruption, is what's known as an uninsured or underinsured motorist. They are a financial ghost. You can sue them, sure, but you can't get blood from a stone. If they don't have insurance, they almost certainly don't have assets. This is where the true hero of your policy steps out of the shadows. Uninsured and underinsured motorist bodily injury coverage. WIMBI. This is one of the most important coverages you can possibly buy, and it is shockingly inexpensive. Here's how it works. When the at-fault driver has no insurance or not enough insurance, your own insurance company steps in and takes their place. Your UM/MBI coverage acts as the insurance the other driver should have had. It covers your medical bills that exceed your PIP or MedPay. It covers your future medical care. It covers your lost wages far beyond what PIP might cover. But it does something else. Something that no other part of your policy, and not even your health insurance, will ever do. It compensates you for pain and suffering. Pain and suffering isn't just a legal buzzword. It's real life. It's the chronic back pain that means you can't pick up your kids anymore. It's the PTSD that makes you flinch every time you hear tires screech. It's the loss of enjoyment of life, the hobbies you had to give up, the permanent limp, the visible scars. These things don't show up on a medical bill, but they have a profound cost. UM/MBI is the only coverage that provides a financial recovery for that human cost when the person responsible can't pay for it. Without this coverage, you are relying on the responsibility and financial solvency of every single stranger you share the road with. And statistics tell us that's a bad bet. Roughly 1 in 8 drivers in the United States is uninsured. 1 in 8. So now let's take a breath. We've protected the other driver's car with your liability coverage. And now we've wrapped you, your passengers, and your financial future in a 3-layered shield of protection with PIP, MedPay, and uninsured motorist coverage. You're covered. Your body is covered. But what about the one thing that started this whole mess? What about your own 1,000-pound hunk of steel, glass, and plastic that's currently sitting in a tow yard with a blue tarp over its shattered windshield? Who pays to fix that or to replace it? That's where the final 2 pieces of the puzzle come in, and how they work together is something most people don't understand until it's far too late. These 2 coverages are called collision and comprehensive, and they are, without a doubt, the most misunderstood, yet most frequently used parts of any auto insurance policy. They answer the fundamental question. If something bad happens, how do I fix my own car without going broke? Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your vehicle if it's damaged in a collision with another object, or if it overturns. This could be another car, a telephone pole you backed into, a guardrail on a slick road, or even a massive pothole that feels like it could swallow your tire whole. Now, here is the first critical thing you need to burn into your brain about collision coverage. It pays out regardless of who is at fault. Let me say that again. pays out regardless of who is at fault. This is the secret superpower of collision coverage that saves people from financial ruin every single day. To understand why, let's imagine a scenario. Let's meet Sarah. Sarah is a responsible driver. She has a clean record, she never texts and drives, and she just bought a beautiful brand new SUV. She's making a monthly payment on it, and it's her pride and joy. One afternoon, she's sitting at a red light, minding her own business when bam, a distracted driver plows into the back of her hard. Her new SUV is a mess. The trunk is crumpled, the taillights are shattered, the frame is probably bent. The other driver gets out, is incredibly apologetic, and admits it was 100% his fault. He gives Sarah his insurance information. Sarah gets a police report. She thinks, okay, this is terrible, but at least it's clear-cut. His insurance will pay for everything. And that's where the nightmare begins. She calls the other driver's insurance company. The agent on the phone is polite but non-committal. We'll need to open an investigation, he says. We need to speak with our insured to get his statement. Days go by. Sarah calls again. We're sorry, we haven't been able to reach our insured yet, they say. A week passes. Her brand new undrivable SUV is sitting in a tow yard, racking up storage fees. She's trying to get to work, get her kids to school, and she's burning through money on Ubers because she doesn't have a car. She calls the other insurance company again, her voice tight with frustration. They finally tell her they've spoken to their driver, but now they need to get the police report, which could take another week. Then they need to send their own adjuster to look at her car. The timeline keeps stretching. 2 weeks, 3 weeks. All this time, Sarah is without a vehicle, and the at-fault party's insurance company is moving at the speed of a glacier. They have no direct obligation to her, no contract with her. Their primary duty is to their own customer and their own bottom line. This is the trap. This is the quicksand that so many people fall into. They assume that because the other person was at fault, everything will be handled smoothly. But the reality is you are at the mercy of a company you don't pay. A company that has every incentive to delay, deny, and diminish your claim. Now let's rewind the clock. Let's give Sarah collision coverage on her own policy. The accident happens. It's still awful. But this time, after a day of getting the runaround from the other company, she remembers her agent telling her she was protected. She calls her own insurance company. The difference is night and day. Her agent says, Sarah, I'm so sorry this happened. Don't worry. This is exactly why you have collision coverage. We are going to take care of you. Instantly, things start happening. They help her get the car towed to a certified repair shop of her choice. They arrange for a rental car, often on the very same day because she had rental reimbursement coverage, another small but mighty part of a policy. An adjuster is sent out immediately, not in a few weeks. The repair shop works directly with her insurance company, a company they have a relationship with. The repairs are approved and the work begins. All Sarah has to do is pay her deductible. Let's say it's $500. She pays that amount directly to the body shop, and her insurance company pays the other $12,000 in repair costs. She's back in her car, good as new, in a fraction of the time and with a fraction of the stress. But the story doesn't even end there. This is the part that feels like magic. Once Sarah's car is fixed and she's back on the road, her insurance company turns into a bulldog. They go to the at-fault driver's insurance company and say, "You owe us. Your driver caused this accident, and we paid $12,000 to fix our customer's car. We want that money back." This process is called subrogation, and if they are successful in recovering the full amount, which they usually are in a clear-cut case like this, they will then mail Sarah a check for $500, refunding her deductible. Collision coverage isn't just about money, it's about control. It's about service. It's about having your own team in your corner, ready to fight for you, so you can get your life back to normal as quickly as possible. So that's collision. But what about all the other chaos life can throw at your car? What about the deer that leaps out of the darkness on a country road? What about the hailstorm that turns your hood into the surface of the moon? What if you wake up one morning and your car is just gone? Stolen? None of those are a collision. For that, you need the other half of the dynamic duo, comprehensive coverage. The best way to think of comprehensive is its official, more descriptive name, other than collision coverage. It's the catch-all policy for the random, unpredictable, and often bizarre damage that can happen to your vehicle. It's your protection against acts of God and acts of mayhem. Comprehensive covers a huge list of potential disasters, theft and vandalism. Someone breaks your window to steal your gym bag. Or a disgruntled neighbor decides to key your paint job from end to end. Comprehensive covers that. Fire. Whether it's an engine fire or your car is caught in a wildfire. Covered. Natural disasters. Floods, hurricanes, tornadoes, earthquakes. If your car is damaged, comprehensive is your lifeline. Falling objects. A heavy tree branch snaps in a windstorm and crushes your roof. A chunk of ice flies off the truck in front of you on the highway and shatters your windshield. Covered. And of course the big one for so much of America, hitting an animal. That deer, that elk, that bear. If an animal runs into the path of your car, the damage is covered under comprehensive, not collision. This is a crucial distinction that can even affect your rates, as animal strikes are often seen as unavoidable and less likely to be held against you than an at-fault collision. Just like collision, comprehensive coverage comes with a deductible. This is the amount you pay out of pocket before the insurance kicks in. You can choose your deductible level. Common options are $250, $500, or $1,000. It's a simple trade-off. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means the insurance company is on the hook for more, so your premium will be higher. The golden rule is to choose a deductible that you could comfortably pay tomorrow, without causing a financial crisis. Now, the big question, do you actually need these coverages? Unlike liability insurance, which is required by law, collision and comprehensive are technically optional. But for most people, optional is not the right word. If you have a loan or a lease on your car, your lender will almost certainly require you to have both. It's not negotiable. The reason is simple. Until you pay it off, the bank or finance company is the primary owner of that vehicle. It's their asset and they are going to make sure it's protected. But what if you own your car free and clear? This is where it becomes a personal finance decision. The key is to weigh the cost of the coverage against the value of your car and your own financial stability. A good rule of thumb is to ask yourself one simple, powerful question. If my car were totaled tomorrow in a hit and run, could I afford to repair or replace it without derailing my life? If your car is an old beater worth $1,500 and you have $10,000 in savings, paying an extra $400 a year for collision and comprehensive is probably not a wise use of your money. You're better off self-insuring, saving that money and accepting the risk that you might have to buy a new beater if something happens. But if your car is worth $15,000 and you only have $1,000 in your emergency fund, dropping these coverages to save $60 a month is one of the riskiest financial gambles you can make. You are one hailstorm, one distracted driver, one deer strike away from a catastrophic financial problem. You'd be out a $15,000 asset and have no easy way to get to your job, which could spiral into an even bigger disaster. Collision and comprehensive are not just insurance for your car. They are insurance for your life's continuity. They are the firewall between a bad day and a financial catastrophe. We've now protected the people you might hit with your car. We've protected your car itself from crashes and chaos. But in all of this, we've overlooked the most important asset inside that vehicle. You and your passengers. What happens when you get hurt? What pays for the ambulance, the emergency room, the weeks of physical therapy? Who pays your salary when you can't work because of your injuries? Most people think their health insurance has them fully covered, but they are walking straight into a financial buzzsaw of copays, deductibles, and coverage gaps. And the key to avoiding it lies in two little-known coverages that could be the most important ones on your entire policy. They are medical payments coverage and personal injury protection. And if those names sound boring or technical, I need you to ignore that for a moment. Because these two coverages are your financial front line. Your first responders in the chaotic aftermath of an accident. They are the difference between a stressful inconvenience and a full-blown, life-altering financial catastrophe. Let's paint a picture. Imagine you're driving home from work. You're stopped at a red light and bam, someone rear-ends you. It's not a huge crash, but it's a solid jolt. The police come, you exchange information, and you feel a little shaken up. Maybe your neck is a bit stiff, but you think you're fine. You drive your car home. The next morning you wake up, and you can barely turn your head. The pain is sharp, radiating down your shoulder. This isn't just a stiff neck. This is whiplash. So, you do the responsible thing. You go to an urgent care clinic. They examine you, take some x-rays, and give you a prescription for muscle relaxers. They tell you to follow up with your primary care doctor and strongly recommend a few weeks of physical therapy. Now, here's where the nightmare begins for millions of Americans. You have health insurance through your job. It's a pretty standard plan, which means it has a deductible. Let's say your deductible is $5,000. That means you have to pay $5,000 out of your own pocket for medical care before your health insurance pays a single penny. The bill from the urgent care and the x-rays arrives. It's $800. You pay it. Your primary care visit has a $50 copay. You pay it. The physical therapist wants to see you 3 times a week for the next month. Each session has a $40 copay, even after your insurance network discount. That's another $480. And we haven't even factored in the cost of your prescription medication. Suddenly, you are over $1,000 out of pocket, and you're nowhere near meeting that $5,000 deductible. All the while you're in pain. You're stressed. You're dealing with car repairs. And now you're bleeding money. You might be thinking, but the other driver was at fault. Their insurance should pay for this. And you're right, they should. But that process can take months, sometimes even years, especially if the insurance company decides to dispute the extent of your injuries. They might offer you a lowball settlement, forcing you to hire a lawyer, which drags the process out even longer. While you're waiting for that settlement, the bills don't stop coming. Your physical therapist isn't going to wait a year to get paid. The hospital isn't going to pause your bill. They want their money now, and it's coming directly from your bank account. This is the financial buzzsaw. This is where people's lives get derailed by a simple fender bender. But it doesn't have to be this way. This is where medical payments coverage, or MedPay, steps in. Think of MedPay as a dedicated first aid kit for your finances. It is no-fault coverage, which is a critically important detail. It means it doesn't matter who caused the accident. If you are injured in your car, it pays. Period. There are no deductibles. There are no copays. In our story, if you had just $5,000 in MedPay coverage on your auto policy, the entire situation changes. That $800 urgent care bill? You send it to your own auto insurance company, and they pay it directly. The copays for your doctor and physical therapy? You pay them, send the receipts to your insurer, and they reimburse you. Instantly. Your MedPay coverage handles all of those initial painful medical expenses right away, up to your coverage limit. It acts as a perfect bridge. It covers all the gaps in your health insurance, the deductibles, the copays, and it pays immediately. So you're not out of pocket, waiting and fighting with the at-fault driver's insurance company. And here's the kicker. MedPay is shockingly inexpensive. For many people, adding $5,000 or even $10,000 of this incredible protection costs just a few dollars a month. It is often the single best value on an entire auto insurance policy. Even better, it doesn't just cover you. It covers every single passenger in your car at the time of the accident. So if you're driving your kids or your friends, they're protected too. But it gets even better. In about a dozen states, there's a supercharged version of MedPay called Personal Injury Protection, or PIP. If you live in a state like Florida, Michigan, New York, or Texas, you're likely required to have it. And if MedPay is a first aid kit, PIP is a full-blown trauma center. Like MedPay, PIP is no-fault coverage that pays for your initial medical expenses regardless of who caused the accident. But it does something MedPay doesn't. Something that can be even more important than covering doctor's bills. PIP covers lost wages. Let's go back to our story one last time. Your whiplash is severe. Your doctor tells you that you can't work for 3 weeks because you can't sit at a desk and look at a computer screen all day. If you have a job that doesn't offer paid sick leave, or you've already used it up, what happens? You lose 3 weeks of income. For most families, that is a devastating financial blow. Your medical bills are piling up, and now your income has vanished. This is how people lose their apartments, miss car payments, and spiral into debt. But with personal injury protection, that doesn't happen. PIP will typically pay up to 80% of your lost income, while you're unable to work due to your injuries, up to your policy limit. It keeps the money flowing into your household when you need it most. It allows you to focus on healing, not on how you're going to pay your rent. And PIP doesn't even stop there. It can also cover what are called replacement services. Let's say you're a stay-at-home parent and your injuries prevent you from doing daily tasks like cleaning the house, cooking, or taking care of your children. PIP can actually reimburse you for the cost of hiring someone to help with those essential household services. It is an unbelievable layer of protection that most people have no idea even exists. So why is this so critical to understand? Because in the modern world of high-deductible health plans, your health insurance isn't the safety net you think it is. An accident can create thousands of dollars in immediate out-of-pocket medical bills that you are responsible for right now. MedPay and PIP are designed specifically for this scenario. They are the specialized tools that protect your savings, your credit score, and your peace of mind in the immediate aftermath of a crash. So I urge you right now, pull up your own auto insurance policy on your phone or computer. Look for the words medical payments or personal injury protection. See what your limit is. Is it $1,000? $5,000? Is it zero? If it's low, or if you don't have it at all, call your agent or go online and get a quote to increase it. You will be stunned at how little it costs to add a profound layer of financial security to your life. For the price of a couple of coffees a month, you can ensure that a minor accident doesn't turn into a major financial crisis. This is about taking control. It's about understanding that your auto insurance isn't just about fixing your car. It's about protecting your health, your income, and your entire financial well-being. But even with the perfect medical coverage, there's a ticking time bomb on your policy that most people don't even know exists. It has nothing to do with your car or your immediate health bills, but it could be the single most financially devastating part of an accident. And it all comes down to two little letters. B. I. Bodily injury. This is your bodily injury liability coverage, and it is, without a doubt, the most important part of your entire auto insurance policy. It's also the part that is most dangerously misunderstood. Why? Because it has absolutely nothing to do with you. It doesn't cover your hospital bills. It doesn't pay for your lost wages if you can't work. It does one thing and one thing only: it pays for the medical bills, the lost income, and the pain and suffering of the people you injure in an accident where you are at fault. And this is where millions of well-meaning, responsible drivers make a catastrophic financial mistake. They look at their policy, they see they're paying for something called bodily injury, and they assume quite reasonably that it must be for their body. It's not. It's a shield. It's a financial fortress designed to stand between someone else's medical catastrophe and your life savings. And for most people, that fortress is made of cardboard. Let me tell you about a guy we'll call David. David is a classic American success story. He's 45, works in IT, makes a good living. He has a wife, 2 kids, a nice house in the suburbs with a mortgage, 2 cars, a 401k he's been diligently contributing to, and a college fund for the kids. He's done everything right. He considers himself a safe driver, no accidents in over a decade. He has what he calls full coverage on his cars. He pays his premium every 6 months and doesn't think much about it. One Tuesday afternoon, he's driving home from work. He's a little distracted, thinking about a project deadline, what to make for dinner. He glances down at his phone for just a second to check a notification. In that 1 second, the car in front of him, a minivan, stops suddenly to avoid a squirrel. David slams on his brakes, but it's too late. It's not a high-speed crash. It's a classic fender bender. A crunch. Airbags don't even deploy. He gets out. The other driver, a woman we'll call Susan, gets out. They're both shaken but seem okay. The police come. A report is filed. Insurance information is exchanged. David's car has a crumpled hood. Susan's minivan has a dented bumper. David's insurance, because he has collision coverage, handles his car repair. He pays his $500 deductible, and in a week, his car is as good as new. He thinks the ordeal is over, but it's just beginning. A month later, David gets a letter from an attorney. Susan, the driver of the minivan, is suing him. It turns out that during that seemingly minor impact, she suffered a severe cervical sprain, a whiplash injury that didn't present itself fully for a few days. She's been in excruciating pain. She's had to see specialists, get MRIs, and is now undergoing months of intensive physical therapy. She's a freelance graphic designer and hasn't been able to work because of the pain and the constant doctor's appointments. David isn't too worried at first. This is what insurance is for, right? He forwards the letter to his insurance company. His adjuster calls him and says, "Don't worry, David, we'll handle it." And they do. They investigate, they negotiate, but Susan's medical bills are legitimate and they're climbing fast. Her medical bills total $85,000. Her documented lost income is $50,000. That's $135,000 in direct economic damages. Then her attorney adds a claim for pain and suffering, for the severe impact this has had on her quality of life. They demand $300,000 to settle the case. Now comes the phone call that changes David's life. His insurance adjuster calls him. The tone is different this time. It's somber. The adjuster says, "David, we have a problem. We've evaluated the claim. and we're going to offer the other party your policy limit to try and settle this. David asks, "Okay, what is my policy limit?" And the adjuster says the words that make his blood run cold. "You have state minimum liability coverage. For bodily injury, your limit is $25,000 per person and $50,000 per accident." Let's pause here. This is the financial time bomb. 25/50ths. You see these numbers on your policy. The first number is the maximum your insurance will pay for any one person's injuries. The second number is the maximum they will pay for all injuries combined in a single accident, no matter how many people you hurt. So for Susan's $135,000 in medical bills and lost wages alone, David's insurance writes a check for $25,000. And that's it. That is the absolute limit of their legal obligation. They have fulfilled their contract with David, but Susan is still owed $110,000, plus whatever a jury might award her for pain and suffering. So where does that money come from? Comes from David, personally. Susan's attorney rejects the $25,000 offer and takes David to court. They win easily. The jury awards Susan her full damages plus another $100,000 for pain and suffering. The total judgment against David is $235,000. His insurance paid $25,000. He is now personally legally on the hook for $210,000. And they will get it. An army of collection lawyers will descend. They can garnish his wages, taking a percentage of his paycheck every single week before he even sees it. For years. For decades. They can put a lien on his house, meaning if he ever sells it, they get their money first. They can seize the money in his bank accounts. They can go after his non-retirement investments. That college fund he so carefully built for his kids? Gone. The dream of retiring comfortably? Evaporated. His entire financial future, everything he worked for his entire life, is fundamentally and permanently altered. All because of a 2-second glance at his phone and a policy limit that was designed to be legal, not to be safe. State minimum liability coverage is a trap. It allows you to legally drive on the road, but it offers a terrifyingly low level of protection in the modern world. One single night in an ICU can cost more than $25,000. A single surgery can cost $50,000. If you hit a car with 3 people in it, and they all have moderate injuries, that $50,000 per accident limit is gone in a flash, and you're responsible for the rest. And we haven't even talked about the third number on your policy. You might see something like 25/50/25. That last number is your property damage liability. In this case, it's $25,000. That's the maximum your policy will pay for any property you damage. That sounds like a lot until you realize what things cost. Sure, it might cover the cost of hitting a 10-year-old Toyota. But what if you swerve and hit a brand new Mercedes S-Class? That's a $100,000 car. What if you hit a Tesla Model X? $120,000. What if you cause a chain reaction and damage 3 or 4 cars? What if you slide on ice and hit the side of someone's house? That $25,000 limit is a joke. And again, once the insurance company pays its limit, the rest comes from you. Here is the single most important piece of advice you will ever get about car insurance. Raising your liability limits is the cheapest and best investment you can possibly make in your financial security. The difference in premium to go from a dangerously low 25/50/25 policy to a much safer 100/300/100 policy, that's $100,000 per person, $300,000 per accident, and $100,000 in property damage, is often shockingly small. We're talking maybe $10, $15, $20 a month. It is the best deal in the entire insurance industry. For the price of a few cups of coffee, you buy hundreds of thousands of dollars of protection that shields your home, your savings, and your future. You need to see liability insurance not as a legal requirement, but as asset protection. The more you have to lose, the more you need to protect. Choosing state minimum coverage is like building a beautiful home, and then locking the front door with a zip tie. It's a purely symbolic gesture that will fail the second it's actually tested. So I urge you tonight, go pull up your insurance policy online. Look for those numbers. Bodily injury and property damage liability. If you see numbers like 25/50ths or 50/100, you are carrying a massive, unnecessary risk. Call your agent or go online and get a quote to increase them. Go to at least 100/300/100. If you can afford it, go to 250/500/100. You will be amazed at how little it costs to buy yourself a fortress of financial protection. This is the core of being properly insured. It's not about fixing your fender. It's about making sure one bad moment on the road doesn't undo a lifetime of hard work. But even this level of protection, this fortress, has a limit. What happens if you cause an accident with catastrophic multi-million-dollar injuries? What happens when even a $500,000 limit isn't enough? There is another layer of protection, a sort of financial superpower, that most people don't even know is available to them. It costs less than your Netflix subscription, and it sits on top of everything, acting as the ultimate shield. And that's what we need to talk about next. This ultimate shield has a name. It's called a personal liability umbrella policy. And it is, without a doubt, the single most important and tragically overlooked piece of financial armor that almost anyone can own. It's the one policy that can stand between you and complete financial obliteration from a single unlucky moment. To understand why, I want you to meet the Miller family. They're a great family. Two parents working hard, saving for retirement, putting money away for their kids' college education. They live in a nice but not extravagant home in the suburbs. They have a 17-year-old son, Jake. He's a good kid, gets decent grades, plays on the soccer team. And like millions of teens, he just got his driver's license. One Tuesday afternoon, Jake is driving the family minivan home from practice. He's following all the rules. He's not speeding. He's not drinking. But for a split second, his phone buzzes in the center console. A text from his friend. He knows he shouldn't, but he glances down. Just for a second. But a second is all it takes. The car in front of him, a late-model Mercedes, had slammed on its brakes to avoid a deer. Jake doesn't see it. He plows into the back of the Mercedes at 45 miles per hour. The impact shoves the Mercedes into oncoming traffic, where it's T-boned by an SUV. The aftermath is catastrophic. The driver of the Mercedes is a neurosurgeon. His right hand is crushed in the accident. His career, a career that earned him over $1 million a year, is over. In the SUV was a young couple with their infant in the back. The husband suffers a severe spinal cord injury, leaving him paralyzed from the waist down. The wife has multiple fractures and a traumatic brain injury. The Millers are, of course, devastated. But their nightmare is just beginning. The lawsuits arrive. The neurosurgeon sues for loss of future earnings. The young family sues for a lifetime of medical care, pain and suffering, and lost income. The Millers thought they were responsible. They had good auto insurance. They had liability limits of $250,000/500/100. Remember what that means. $250,000 per person, $500,000 total per accident for bodily injury. Their insurance company pays out that full $500,000 immediately. But the total judgment against them, against 17-year-old Jake and his parents, isn't $500,000. After months of litigation, the court awards the victims a combined total of $3 million. Their insurance paid $500,000. Where does the other $2.5 million come from? It comes from the Millers. It comes from everything they have ever worked for, and everything they ever will work for. The court places a lien on their house. Their savings accounts are seized. The college funds they so carefully built for their children are wiped out in an instant. Their retirement accounts are drained. And even after all of that, they still owe over $1 million. So the court garnishes their wages. For the rest of their working lives, a significant portion of every single paycheck they earn will go to paying off this judgment. They are financially ruined. A single 1-second glance at a text message didn't just cause an accident. It erased their family's entire financial future. Now let's rewind. Let's go back to that Tuesday morning before Jake ever got in the car. But in this version of reality, 6 months earlier, the Millers' insurance agent convinced them to add a $2 million umbrella policy to their plan. It cost them about $40 a month, less than their family's streaming subscriptions. The accident still happens. The tragedy is still real. The injuries are just as severe. The $3 million judgment is still handed down. Their auto insurance still pays out its maximum of $500,000. But what happens to the other $2.5 million? Nothing. Because that umbrella policy, that $40 a month shield, kicks in right where their auto insurance left off. It was designed for exactly this moment. The insurance company writes a check for $2 million, the policy limit, to cover the rest of the judgment. The Millers are still on the hook for the remaining $500,000, which is still a devastating blow. But it's a blow they can potentially recover from. They might have to take out a second mortgage, they might have to work a few more years, but they don't lose everything. Their retirement isn't completely gone. Their other kids can still go to college. They are not sentenced to a lifetime of financial servitude. They were saved from ruin by a policy that cost them less than a tank of gas each month. That is the power of an umbrella policy. It is catastrophe insurance. It sits on top of your existing policies, like your auto and your homeowner's insurance, and it only comes into play when you've exhausted the liability limits on those underlying policies. And it's not just for car accidents. Let's say you have a pool party, and a guest slips on the wet patio, hits their head and suffers a serious injury. They sue you for $1 million. Your homeowner's insurance might have a liability limit of, say, $300,000. Pays that out. Your umbrella policy then activates and covers the remaining $700,000. Your dog bites the neighbor's kid. Your teenager writes something defamatory online that leads to a lawsuit. These are all things an umbrella policy can cover. Now, there are a couple of crucial things to know. You can't just buy an umbrella policy on its own. Insurance companies require you to have solid underlying coverage first. They'll typically mandate that you have at least $250,000/500/100 on your auto policy and at least $300,000 in liability on your homeowner's policy before they will even sell you an umbrella. They want to know that you have a good fence before they sell you the fortress. And here's the biggest misconception I have to fight every single day. People think umbrella policies are only for the rich. They hear $1 million policy and think, well, I don't have $1 million in assets, so I don't need one. That is dangerously wrong. In many ways, an umbrella policy is more important for a middle-class family than it is for a billionaire. Why? Because a court doesn't just look at what you have now. It looks at your future. They will garnish your future wages. They will seize your future assets. If you have a decent job, own a home, have some savings, and plan to work for the next 20 or 30 years, you are a target. You have enough to lose to make a lawsuit worthwhile for an attorney, but not enough to absorb the hit without being completely wiped out. The wealthy have complex trusts and legal teams to shield their assets. A middle-class family has an umbrella policy. It is the great equalizer in a lawsuit. For about $200 to $500 a year, you can buy $1 million, $2 million, even $5 million in extra liability protection. It is, dollar for dollar, the best value in the entire world of insurance. A single bad day, one moment of distraction, can generate a lawsuit that erases 30 years of hard work. The difference between recovering from that day and being crushed by it is often this one simple policy. So we've covered your primary liability, and now this massive, overarching layer of protection. But what about the threats that come from the other direction? It's not just about the damage you might cause. It's about the damage others can cause to you. Especially the shockingly high number of people driving on our roads with no insurance at all. Protecting yourself from them requires a completely different kind of coverage, one that is often misunderstood, but is absolutely critical to your own physical and financial well-being. And that hidden danger is exactly what we need to break down next. That hidden danger is the shocking number of drivers on the road who have either zero insurance or insurance that is so laughably inadequate it might as well be nothing. We spend all this time and money buying liability insurance to protect other people from us, but what about protecting us from them? This is our fourth key thing to know, and it might just be the most important one on the entire list. Understanding uninsured and underinsured motorist coverage. Let's imagine a scenario. You're a responsible driver. You pay your premiums on time, you have good liability limits, maybe 100/300/100, just like we talked about. You feel protected. One afternoon, you're sitting at a red light minding your own business when suddenly, bam, you're rear-ended. Hard. The crash is violent, your car is crumpled, and you feel a sharp searing pain in your neck and back. An ambulance comes, you go to the hospital. The other driver is clearly at fault. He ran the red light while texting. It's a slam dunk case. At the hospital, you're diagnosed with a couple of herniated discs and severe whiplash. The doctors say you'll need months of physical therapy, and you definitely can't go back to your job, which involves physical labor, for the foreseeable future. Your car, a reliable sedan worth about $18,000, is declared a total loss. Between the ambulance, the emergency room, the MRIs, and the initial specialist visits, your medical bills are already pushing $30,000, and they're just getting started. Add in your lost wages and the value of your totaled car, and you're easily looking at over $100,000 in damages. But hey, the other guy was at fault, right? His insurance should cover it. So you get the police report and you make the call. And that's when your entire world collapses. The person who hit you only had the state minimum liability coverage. In their state, that's $25,000 for bodily injury per person, and $10,000 for property damage. Let that sink in. Your medical bills are already past $30,000. Your car is worth $18,000. The insurance company for the guy who caused all of this sends you a check for $25,000 for your injuries and $10,000 for your car. That's it. That's all they are legally required to pay. You are now left with a $5,000 medical debt that's still growing, no car to get to your physical therapy appointments, no income, and a long painful recovery ahead. The person who did this to you walks away with a slap on the wrist, and you are left financially and physically ruined. This isn't a scare tactic. This exact scenario plays out every single day all across America. And it's even worse if the driver who hits you has no insurance at all, or if it's a hit and run and you never find them. In those cases, you get nothing. Zero. This is where uninsured and underinsured motorist coverage, or UM/UIM, becomes your financial lifeboat. It is insurance you buy for yourself to protect yourself from the irresponsible. It steps in and acts like the insurance the other driver should have had. Let's break it down. There are two main parts. First, and most critically, is uninsured and underinsured motorist bodily injury, or UMBI. This is the hero of our story. This coverage pays for your medical bills, your lost wages, and your pain and suffering when you are hit by a driver with no insurance or not enough insurance. It also covers your passengers in the car with you. In our scenario, if you had UMBI coverage with limits of say 100/300, the same as your own liability, here's what would happen. The other driver's insurance would pay out their maximum of $25,000. But your damages are far greater. So, your own insurance company would then step in, and your underinsured motorist coverage would cover the rest, up to your limit of $100,000 per person. It would pay the rest of your medical bills. It would compensate you for the wages you lost while you couldn't work. It would fill that massive, terrifying gap and make you whole again. It saves you from bankruptcy. You might be thinking, what are the odds of this actually happening? Well, the Insurance Research Council estimates that about 1 in every 8 drivers on the road is uninsured. That's over 12%. And in some states like Mississippi, it's over 29%. Florida, 20%. Michigan, 20%. That means in some places, there's a 1 in 4 or 1 in 5 chance that the car coming towards you at an intersection has absolutely no insurance. And that doesn't even count the millions more who, like the driver in our story, have only the bare minimum limits that won't even cover the cost of a minor surgery. You are literally betting your entire financial future on the hope that if you get into a serious accident, the person who hits you happens to be one of the responsible ones. That is a terrible bet to make. This is why, when you buy auto insurance, you should always match your uninsured motorist bodily injury limits to your own bodily injury liability limits. If you have 100/300 in liability to protect others, you need 100/300 in UMBI to protect yourself. It is shockingly inexpensive for the monumental level of protection it provides. It is the single best value purchase in all of insurance. Do not let an agent talk you out of it. Do not waive this coverage to save $12 a month. It is the armor you wear into battle. Now there's a second, less critical part. Uninsured motorist property damage, or UMPD. This, as the name implies, covers damage to your car if you're hit by an uninsured driver. In our story, the other driver had $10,000 of property damage liability, but your car was worth $18,000. You'd be out $8,000. UMPD could have covered that gap. However, this is where it gets a little tricky. UMPD often has a lower limit, maybe $25,000 or so. And if you already have collision coverage on your policy, which we'll talk about next, collision would also pay to fix or replace your car, regardless of who is at fault. So there can be some overlap. In fact, some states don't even offer UMPD, and instead require you to use your collision coverage in a hit and run, or if you're hit by an uninsured driver. The main benefit of UMPD is that the deductible is often much lower than a collision deductible, sometimes only a couple $100s. But the absolute non-negotiable part of this coverage is the bodily injury portion. It protects your health, your body, and your ability to earn an income. Your car can be replaced. You can't. So the fourth key is to stop thinking about insurance as just something you buy for other people. You must insure yourself against the massive risk posed by millions of uninsured and underinsured drivers sharing the road with you. It is a predictable, statistically significant threat. And UM/UIM coverage is the only shield you have. You've now protected yourself from your own mistakes and from the mistakes of others. But what about everything else? What about the deer that jumps out of nowhere? The hailstorm that turns your car into a golf ball? Or the shopping cart that mysteriously rolls across the parking lot and smashes into your door? Protecting your actual vehicle from the chaos of the world is a whole different ball game. and it involves two types of coverage that are often confused, but are the only thing standing between you and writing a check for a brand new car out of your own pocket. And understanding that difference is our final crucial key. This is where we separate the fender benders from the financial catastrophes. Everything we've talked about so far, liability coverage, is about paying for damage you do to other people and their property. It's your legal shield. But it does absolutely nothing for the 7,000-pound hunk of steel, glass, and plastic that you're sitting in. If you cause an accident, your liability coverage will pay to fix the other person's Lexus, but it won't give you a single dime to fix your own crumpled Toyota. That's a different ballgame, and it involves two types of coverage that are often confused, but are the only thing standing between you and writing a check for a brand new car out of your own pocket. And understanding that difference is our final crucial key. These two coverages are collision and comprehensive. Together, they're often called physical damage coverage, and they are your car's personal bodyguards. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. The key words there are your car and collision. Imagine you're pulling out of a tight parking spot. You're checking your mirrors, you're looking over your shoulder, but you misjudge the distance to that concrete pillar. You hear that gut-wrenching scrape of metal on concrete. Your heart sinks. You get out and see a nasty gash running the length of your passenger side door. That's a collision. Or picture a more serious scenario. You're driving through an intersection on a green light, and another driver, buried in their phone, blows through their red light and T-bones you. It's a violent, terrifying moment. The airbags deploy, the car spins to a stop. You're shaken but okay, but your car is totaled. The frame is bent, it's completely undrivable. The other driver was clearly at fault, but dealing with their insurance company could take weeks, maybe months of fighting and paperwork. In both of these cases, collision coverage is your hero. It doesn't care who was at fault. Whether you hit a pole or someone else hit you, you file a claim with your own insurance company, you pay your deductible, and they handle the rest. They will pay for the repairs, or if the car is a total loss, they will cut you a check for the car's actual cash value. That's the market value of your car right before the accident happened. This gets you back on your feet quickly, while your insurance company can go fight the other driver's insurance for reimbursement in a process called subrogation. You get your money fast, they handle the battle. Now, what's a deductible? Think of it as your share of the repair cost. It's the amount you agree to pay out of pocket before the insurance company starts paying. Deductibles typically range from $250 to $1,000, or even more. If you have a $1,000 deductible and the repairs cost $8,000, you pay the first $1,000, and your insurer pays the remaining $7,000. Simple as that. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower premium. A lower deductible means less risk for you, so your premium will be higher. So, collision covers you when you hit something. But what about all the other ways a car can be ruined? What about the chaos of the world that has nothing to do with a crash? This is where collision's partner, comprehensive coverage, steps in. Comprehensive is sometimes called other than collision coverage, which is a perfect description. Protects your car from damage caused by, well, pretty much everything else. Think of it as the insurance for life's random, unlucky moments. A hailstorm rolls through and turns the hood of your car into the surface of a golf ball. That's comprehensive. You're parked under a big oak tree during a windstorm, and a massive branch snaps off, caving in your roof. That's comprehensive. You're driving down a country road at dusk, and a deer decides to leap out in front of you. Hitting an animal is not considered a collision in the insurance world. It's a comprehensive claim. What if you walk out to your car in the morning and find your window smashed and your stereo ripped out? Vandalism and theft, both covered by comprehensive. Fire, floods, earthquakes, riots. All of these fall under the comprehensive umbrella. It's the catch-all for non-accident related damage. Just like collision, it has a deductible that you have to pay first. So if that deer caused $3,000 in damage and you have a $500 comprehensive deductible, you pay $500, and insurance covers the remaining $2,500. So you have collision for crashes and comprehensive for chaos. The big question then becomes, do you actually need them? Unlike liability insurance, no state legally requires you to carry collision or comprehensive coverage. This is an optional choice. However, you might not have a choice at all. If you have a loan on your car or if you're leasing it, your lender or leasing company will almost certainly require you to have both. Why? Because until you pay it off, they are the true owners of the vehicle. It's their asset, and they are not going to let you drive their multi-thousand-dollar asset around without full protection. They need to know that if the car is wrecked or stolen, their investment will be paid back. If you drop the required coverage, your lender can and often will buy a policy for you called force-placed insurance and tack the very expensive bill onto your loan payment. So if you have a loan or a lease, the answer is yes, you need them. But what if you own your car free and clear? This is where it becomes a personal finance decision. It boils down to one simple, crucial question. If your car was totaled tomorrow, could you afford to replace it without causing a major crisis in your life? If your car is a 20-year-old beater worth maybe $1,500, and you have a healthy emergency fund, paying for collision and comprehensive might not make sense. The cost of the insurance over a year or two could easily exceed the value of the car itself. You're better off self-insuring. That is, banking the money you would have spent on premiums and saving it for an eventual replacement car. A good rule of thumb many people use is the 10% rule. If the annual cost for your collision and comprehensive coverage is more than 10% of your car's cash value, you should seriously consider dropping it. For example, your car is worth $3,000. You look up its value on Kelley Blue Book. You call your insurance agent and find out that the physical damage portion of your premium is $400 a year. That's over 13% of the car's value. In this case, you might decide it's time to let it go. But, and this is a huge but, you have to be brutally honest with yourself. It's not just about the car's dollar value, it's about its value to your life. If that $3,000 car is your only way to get to a job that pays you $40,000 a year, and you don't have $3,000 in the bank to replace it, then that $400 insurance premium is a brilliant investment. It's a safety net that keeps your entire life from unraveling over one bad day. Choosing your deductible is a similar exercise in financial honesty. It's tempting to pick a high deductible, like $2,000, to get the lowest possible monthly premium. But if you get into an accident, do you have $2,000 you can access immediately to pay the repair shop? If the answer is no, you've chosen the wrong deductible. Your deductible should be an amount that you have saved and can comfortably part with on a moment's notice without having to go into debt. So now we've covered protecting others and we've covered protecting your own car. But we've missed the most important asset of all. What happens when you're injured? Or the other driver has no insurance at all? That's where the final pieces of the puzzle, the ones that protect your body and your bank account from someone else's mistake, come into play. And ignoring them is the single biggest gamble you can take on the road. This is where the shield you build for yourself becomes the most important thing you own. We're talking about uninsured and underinsured motorist coverage. Let's call it UM and UIM for short. And it is, without a doubt, one of the most critical yet most misunderstood coverages you can buy. Think about this statistic for a second. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. Look around you the next time you're at a busy intersection. Count the first 8 cars you see. Statistically, one of them is a financial ghost, driving without the legally required safety net. In some states like Mississippi or Florida, that number is closer to 1 in 4. It's a terrifying game of Russian roulette, and you're forced to play it every single time you get behind the wheel. So what happens when that ghost crashes into you? They caused the accident, they totaled your car, they sent you to the hospital, but they have no insurance. Your liability coverage does nothing. That's for damage you caused to others. Your collision coverage will fix your car, but you'll have to pay your deductible, and your rates might still go up. But what about your medical bills? What about your lost wages because you can't work? What about the pain and suffering from an injury that could affect you for the rest of your life? Normally, you would file a claim against the at-fault driver's bodily injury liability insurance, but they don't have any, so your only option is to sue them personally. And let's be honest, someone driving without insurance is highly unlikely to have a 6-figure savings account or a mansion you can put a lien on. You can win a lawsuit and still get nothing. It's called being judgment-proof. You're left holding the bag for tens, or even hundreds of thousands of dollars in medical debt, all because someone else broke the law. This is where uninsured motorist coverage rides in like the cavalry. When you have UM coverage, you are essentially buying an insurance policy for the person who hits you. If they have no insurance, your own insurance company steps into their shoes and pays for your damages, up to the limits you selected. It covers your medical bills, your passengers' medical bills, lost wages, and pain and suffering. It is your ultimate defense against the most irresponsible people on the road. Now, what about the underinsured part? This is just as important. Let's go back to that scenario where you were hit and your medical bills are $100,000. But this time, the driver who hit you wasn't a ghost. They were following the law. They had insurance. The problem is, they only had the state minimum coverage. In many states, the minimum bodily injury liability is just $25,000 per person. So, their insurance company cuts you a check for $25,000. That's all they're legally required to pay. What about the other $75,000 you owe the hospital? Again, you're stuck. You can sue for the rest, but you'll run into the same problem. This is where underinsured motorist, or UIM coverage saves you. Covers the gap. It kicks in after the other driver's insurance maxes out, and it pays the difference up to the limit you chose for your UIM policy. The golden rule here is simple. You should always carry UM and UIM coverage with limits that are at least equal to your own bodily injury liability limits. If you have a policy to protect others from you with $100,000 in coverage, you absolutely need a policy that protects you from others with that same $100,000 in coverage. To do anything less is to bet your entire financial future on the hope that every stranger you share the road with is both a perfect driver and a financially responsible person. And that is a sucker's bet. This brings us to our fifth and final key thing to know about auto insurance. Understanding the smaller, but vital coverages and mastering the art of shopping for a policy. Let's quickly talk about two more optional coverages that act as your first line of defense. Medical payments coverage, or MedPay, and personal injury protection, or PIP. These are often called no-fault coverages because it doesn't matter who caused the accident. If you have this coverage, it pays out for your medical expenses and those of your passengers immediately. Think about it. After a crash, it can take weeks or even months for the insurance companies to investigate, determine fault, and finally cut a check. But your hospital bills, your ambulance ride, your copays, those are due now. MedPay or PIP is designed to cover those immediate costs, up to a certain limit, usually somewhere between $1,000 and $10,000. It's a fantastic buffer that prevents you from having to pay out of pocket, while the big liability questions are sorted out. In some no-fault states, PIP is actually mandatory and is much more comprehensive, even covering lost wages. But even if it's optional where you live, adding a few $1,000s in MedPay coverage can be an absolute lifesaver for a very small addition to your premium. And of course, there are the other add-ons like rental reimbursement, which pays for a rental car while yours is in the shop after a covered claim, and roadside assistance for towing or a flat tire. These are convenience coverages. They aren't going to save you from financial ruin, but for a few dollars a month, they can turn a massive headache into a minor inconvenience. So now you understand the pieces.
Liability, collision, comprehensive, UIM, MedPay.
You know what they do and why you need them. The final step is putting it all together to build your fortress and do it without overpaying. The secret isn't just to find the cheapest price. It's to find the best value. First, you must shop around. I cannot stress this enough. The price for the exact same coverage on the exact same car for the exact same driver can vary by hundreds, or even thousands of dollars from one company to the next. Never assume the company you've been with for 10 years is giving you the best deal. Loyalty is rarely rewarded in the insurance world. Every year or two, get quotes from at least 3 to 5 different companies, and consider using an independent insurance agent. Unlike a captive agent who only works for one company, an independent agent works for you. They can pull quotes from a dozen different insurers at once to find the best fit for your specific needs. Second, ask about discounts. You would be amazed at what you can get a discount for. Good student discount, safe driver discount, taking a defensive driving course, having anti-theft devices or daytime running lights on your car. The single biggest discount is almost always bundling. Having your auto insurance and your home or renter's insurance with the same company. Go down the list with your agent and ask, what other discounts am I eligible for? Don't leave free money on the table. Third, choose your deductible wisely. Remember, this is the amount you pay out of pocket for a collision or comprehensive claim before the insurance company pays a dime. A higher deductible means a lower premium, which is tempting. A $1,000 deductible will give you a much cheaper rate than a $250 deductible. But you have to be brutally honest with yourself. If you had an accident tomorrow, could you comfortably write a check for $1,000 without causing a financial crisis? If the answer is no, you have too high a deductible. The sweet spot is the highest deductible you can easily afford to pay on a moment's notice. Finally, review your policy every single year. Don't just let it auto-renew without looking at it. Did you get a new job with a shorter commute? That could lower your rate. Did you pay off your car loan? You might decide you no longer need gap insurance. Did you get a big raise? Maybe it's time to increase your liability limits to protect your new, higher net worth. Your life is not static, and your insurance policy shouldn't be either. In the end, auto insurance is so much more than a legal requirement. It's not just a piece of paper you show a police officer. It is a deeply personal financial tool that shields your life's work from a split-second mistake, yours or someone else's. It's the wall that stands between a bad day and a bad decade. By understanding these 5 key areas: liability, your car's protection, your own protection from others, the crucial extras, and how to shop smart, you're no longer just a driver. You are the architect of your own financial security. You're in control. So take another look at that little card in your glove box. It's not an expense. It's a promise. A promise that if the worst happens, you and your family will be made whole again. The goal isn't just to be insured. The goal is to be protected, to be prepared, and to have the peace of mind that allows you to simply enjoy the journey. Drive safe and drive smart.